Not every trust is real in the eyes of the IRS. If your trust exists only on paper and serves no legitimate economic purpose, it might not protect anything, and it could land you in some serious tax trouble. Hi, I'm John Strohmeyer with Strohmeyer Law, where we help our clients leave no unfinished business. While I am a lawyer, I'm not your lawyer, so don't take the advice of some talking head on the internet. Make sure you've got your own advisors who are advising you on your specific circumstances. Also, please remember to like, comment, and subscribe. Now, today we're going to be talking about how and why a trust might be completely ignored for tax purposes. Generally, it's because it's a worthless scam. This is going to fall under our potential avoidable costs as one of the four horsemen of the estate planning apocalypse. Why? Well, fake trusts can trigger audits, tax penalties, interest, and sometimes even criminal charges. Why does this matter? Well, trusts are powerful tools when they're used correctly. As an estate planner, I use trusts all the time. I'm thinking about grantor trusts, I'm thinking about non-grantor trusts, irrevocable trusts and revocable trusts, testamentary trust, inter vivos trusts, GRATs, CRUTs, NIMCRUTs. There are all sorts of trusts that are out there that make sense for people at the right time. Not everybody all at once. But when trusts are misused to create tax shelters that have no economic purpose, courts and the IRS can and will disregard them. So what we're going to do is talk about the decision process and the tests that the courts use to decide when a trust is legitimate and when it's just a sham. So some background, the IRS does have a lot of information online about what they consider to be the abusive trusts. And this is not meant to be an exhaustive list, but it's a way of looking at what is out there and what they consider to be abusive. For example, a family residence trust. Well, there is a type of trust called a qualified personal residence trust. You can get a copy of that trust agreement directly from the IRS. It's a valid tool that sometimes makes sense for clients to use to lower their future estate tax obligations. But this family residence trust sounds something like that, but it doesn't do the same thing. And what it's trying to do is generate depreciation deductions for your own personal residence, which you can't do. Depreciation, generally speaking, is there for when you're using an asset in a business to recognize that as you use it, it's being degraded. Personal use assets don't get depreciation. And so this family residence trust, the idea is, well, here, we'll put it in trust, we'll start paying rent. Maybe we won't actually pay rent. We certainly won't pay any income tax on that rent, but we're going to start generating income tax depreciation deductions for this so that we can have a lower tax bill. It's not going to work. Charitable trusts get misused a lot where people think that, well, my religion isn't one of the major ones, and because it's a religion, the IRS doesn't get to come in and look at it. It doesn't really work that way. Again, the IRS has the ability to audit to make sure the system is working correctly. Asset protection trusts could work as well. And finally, our favorite 643B trust, where folks are misreading what 643B says and trying to eliminate their income tax by allocating fiduciary accounting income to fiduciary accounting corpus. That's fine. The IRS doesn't care necessarily about that. What they do care about is what 641A says, which is that all income is taxable, and the trustee is going to have to pay tax on it, except to the extent that it's distributed to the beneficiaries. So these are some of the trusts that they're looking out for. But let's get into the test of how the IRS and ultimately the courts are going to rule that something is a sham trust. So let's talk about the case of Markosian versus Commissioner. This is a case from 1980 where Louis Markosian and his family transferred all their personal assets and business assets, including Louis's dental practice, the equipment, and even Louis's lifetime services into a trust. They were the only trustees. Louis kept running his business exactly the same way, and then the trust charged an 80% fee on his gross income. Well, the tax court wasn't fooled, and ultimately they held that the trust lacked economic substance. The trust was deemed a sham and a nullity for federal income tax purposes. So how did they come to that? Well, there's a four-part test for determining if a trust has economic substance. So from Markosian, as well as later cases, courts look at whether a trust is real based on four factors. First, is there an independent trustee? Second, is there a meaningful change in the control or use of the assets? Third, is there any sort of economic reality or business purpose to this trust? And finally, Fourth, are there any arm's length dealings with the trust? So going back to the top, independent trustee. And frankly, for all of these four tests, any one of them isn't going to make it invalid, but it's used together. It's a four-part test. So again, we help clients create trusts that are grantor trusts as to the grantor. So the same person who's putting assets into the trust is also the trustee. They're not necessarily independent. But as long as they're respecting the agreement, putting assets in trust and dealing with it, well, we don't really have to think about that as much. Yet, as we look at these four tests, keep that in mind. One isn't going to necessarily be enough to sway it one way or another, but it could also be abusive enough that it could make it a total sham. So, independent trustee. We're thinking about whether this trustee is someone other than the person who created the trust or a close family relative. Again, by itself, this is not going to be an automatic strike against the trust. But if we're starting from the point that the person who's putting assets into trust is the same person who's going to be the trustee, well, they're still going to be in control of it. And so it's going to be a red flag. Yeah, we can get past red flags. But think about that. If you're putting someone in charge and it's already you, this may be an indication of a sham trust. Second, has there been a meaningful change in control or use? Now, the people who are giving up control over the assets, do those assets still benefit that same person in the same way? If they don't, if they haven't actually parted with legal benefit from this, well, it's still their asset. What I've seen before in 643B trusts are no beneficiaries are named. They can be named at some point in the future. Well, if the person who is in charge, whether they're called the trustee, the protector, compliance overseer, the distribution advisor, investment advisor, trust advisor, whatever that role is, if they've been wormed back in as a person who can pick who the beneficiaries are, well, they can pick themselves. And this is another way of looking at it of if nothing has changed, well, why should it be respected? For estate and gift tax purposes, we're looking for part in ownership, a partition in that ownership. Have you ever actually let go of what you have? If you haven't, well, you probably haven't made a gift. And there are all sorts of rules about when and how a gift has been made that we're not going to get into today, but that's a good rule of thumb to start thinking about it. Have you actually parted company with this? Sure, you may have put an asset into a trust, but if it's a fully revocable trust, then you can pull that back at any moment. So look at what you have and what can you still control. If you can still control things, it doesn't mean that that trust won't work. It just may mean that it's not valid for income tax purposes. Third, what is the economic reality or business purpose to this trust? So we're looking for some real non-tax reason that this trust was created. If it's just for pure tax benefits, it's rare that we've actually done anything. So again, in the estate and gift tax world, what do we think about? Have you actually let go of this asset? If you're creating a lifetime inter vivos trust that's irrevocable for somebody else, yes, there is a tax benefit. You are going to be using up your estate and gift tax exemption to put those assets into trust. And because you've put those assets into trust, well, you don't have them anymore. The trustee now owns it for the benefit of those beneficiaries. Yes, you are avoiding future estate tax. How? Well, the future value, the future appreciation, growth in those assets will escape estate taxation. That's why we think about it. We're putting them in trust because we're taking them off the balance sheet for you, and then somebody else has the benefit of it. The trustee owns legal title, the beneficiary is going to get the benefit of it, and it's not you anymore. So, yes, we're avoiding taxes, but that's not the only thing going on. What I also see is, well, we're going to sell assets into this trust, so there's no gift tax. Yes, but how is the trust going to get the benefit of those assets? How is the trust going to pay for those assets? Well, the assets are going to generate more income. And I'll say, would you do that for any other person? Is there a third person you would say, here, I'm going to give you this asset and trust that you'll pay me for it later? Because again, if you've got a sale between the two, what you must have is some recognition of gain. How are you reporting the gain on the sale of those assets? Yeah, If you're selling it into the trust and it's a non-grantor complex trust, then that means that that trust is a separate taxpayer. That separate taxpayer is paying you money, and you have to recognize the income on it. And if you don't, well, again, you're looking at potential penalties. The reality, though, is these trusts generally are going to be declared shams. And so there's nothing really happening. It's the left hand passing money to the right hand. So let's move on to our fourth and final test, arm's length dealing. And so as we think about how to review these arm's length dealings, well, would anybody actually deal with it this way? Is the trustee operating like a true fiduciary who has obligations to the assets as well as to the beneficiaries? If no trustee would operate this way, it's hard to say that the deal should be respected or that the transaction or the trust should be respected. So pulling these together, how does this show up? Well, here in Texas, of course, we recognize trust, and their legitimacy for federal tax purposes is determined, though, under federal tax law. So Texas law can't override the IRS's ability to declare a trust a sham if it's going to lack economic reality. That does mean, though, that you may still have a trust agreement that, for Texas state law purposes, is a real thing that does need to be dealt with. So you may think about family limited partnerships or LLCs that can be misused in similar ways. Just calling something a trust or an entity doesn't make it legitimate. And so when we see these cases, they're usually following some of the same principles. Trusts are being used to divert income, but didn't change any of the economics or control. The IRS is then ruling that it lacks economic substance and will be disregarded. So what happens if the IRS declares this a sham trust? Well, that trust didn't exist. So you'll still owe the taxes on this, plus potentially penalties and interest on that. You may also trigger accuracy-related penalties, possibly even civil fraud penalties. Depending on how bad you've been, it could even go up to a criminal investigation if the arrangement was knowingly abusive. And in this case, the burden's going to be on you to prove the trust is legitimate. The problem ultimately is also going to be that while the promoter of this got paid, you're getting stuck with the bill. And what I've seen even in some engagement letters for some of these promoters is they're disclaiming all of the language. They're disclaiming that they've done anything or provided any legal advice. What they're saying is that we've provided you with a trust agreement based on what you've requested, and that's where our liability ends. So what should you be looking out for? Well, there's certain phrases I hear a lot here on YouTube and online. The IRS doesn't want you to know this. The IRS has no problem with you knowing things. All of the planning that's out there will work. They'll tell you what works and they'll tell you what doesn't work. Another one is the secrets that rich use to avoid taxes. I've done work for clients with more money than anybody really should ever have. And there are no secrets like this. Their accountants are working to drive those bills down, but guess what? There's no magic trust that eliminates income tax. Finally, this trust will make your income disappear. And it won't. There's no such thing as that. Beyond that, things to look at in terms of the deals, other things to look out for. If their compensation is based on how much tax you save instead of the work that's being done, that's a big red flag. If they're taking a percentage of the tax saved, that's a huge red flag and something that's ethically compromising them. Why? Because they're going to see that they can make a little bit more money by finding an extra little deduction. And while it sounds good, it leads you down the wrong path. And so that's why most tax advisors don't do that. In fact, I don't know any who do it that way. Beyond that, promoters who don't want to sign anything or provide written legal opinions backing it up. Sure, I've seen a few letters, and eventually on this channel, we'll start going through some of those legal opinions and show just how broken they are. The problem is they're not citing law. They're just waving around and saying it will do this or won't do that. Finally, a red flag is if no CPA or lawyer is willing to put their name on that return, that's a big problem. So what does real planning look like? Well, a real trust is going to have a real trustee. It's not always somebody different than the grantor, but usually it is. Ultimately, though, whatever's going in trust, it doesn't belong to the donor anymore. And it doesn't matter if you've got somebody who sets up themselves up as the initial settlor and then they back out. The people who put the assets into the trust whether they're identified in the trust agreement or not. If they still have the same control and benefit from those assets, that's a big red flag. Next, the trust has to serve some legitimate purpose, whether it's estate planning, asset protection when it's done correctly, charitable giving, passing assets on. But again, there's a real purpose and it's not just tax savings. Finally, they've got to have some sort of coordination with other parts of your plan. There needs to be something that's being done. So remember, a trust with no economic purpose isn't part of a clever tax plan. It's a paper tiger. Courts aren't going to care what you've called it. They will care what it does. So if your trust looks like the setup in Markosian or its progeny like Aldridge, well, it's not going to stand up to IRS scrutiny. It could ultimately cost you a lot more than you are thinking you're going to save. So if you're not sure whether your trust has real substance, make sure you've talked to an advisor about this. Again, there are a lot of ways to do great things with trusts, but eliminating your income tax bill is not one of them. We'll see you next time. Make sure and let us know if you've seen any grand promises in the comments below.